Hello students, in this video we will see what are the asset management ratios. So our learning objective is to understand different types of asset management ratios and how to interpret them. First, under the ratio analysis, we have five different type of ratios. Liquidity ratios, which through which we will try to understand that whether the company will be able to meet its obligation, which will be coming due within 1 year period of time. Second, the asset management ratios, that how effectively and efficiently company is utilizing its assets. Long-term debt paying ability or solvency ratios, which is more important for the bankers and the bondholders, that whether the company will be able to pay their money back to them or not. Then we have a profitability ratios, for which like the shareholders are the main stakeholders, so they want to calculate those profitability ratios. And the market valuation ratios, and it is also again for the investors and the prospective investors, if whether you want to like buy the stocks, or if you already bought the stock, whether you will is it the right time to sell the stocks. Maybe the stock is already overvalued and it is better to get rid of these stocks um, and sell the stocks at the higher price in the stock market. So we will discuss about these traditional ratios, and when we will be calculating these ratios, so they are coming from the different financial statements. Usually the balance sheet and income statement items are involved in calculating these ratios. In liquidity ratios, mostly the items both in the numerator and the denominator, when we will calculate the ratios, comes from the balance sheet. In case of asset management, which we are discussing today, one item is usually coming from the balance sheet and the other one is coming from the income statement, and we'll look into it. So the asset management ratios actually measure that how efficiently company is utilizing its current and the long-term asset. There is a lot more investment done in these uh, assets, and if the company is not able to generate enough sales from these assets, then the company can be at the brink of the bankruptcy. So it's important to see that whether the company is efficiently utilizing these assets to generate the sales. So the purpose of having these assets is to generate sales, and this is what we want to see. These ratios are also called the turnover or activity ratio. Whenever the name turnover comes in your mind, it is associated with the times, that how many times over a particular period. So because we are if we are considering the financial statements for the over for the whole 1 year, then it means that if certain turn over is 8, it means that a particular asset is generating 8 times of its value in terms of sales in that particular year. So most of these turnover ratios relates the company's sales to the value of the total asset or a specific category of the assets, for example the fixed assets. And we want to see that like how efficiently those are generating the sales. So obviously we want more sales to be done, so we want these turnover ratios with the higher number. So higher these turnover ratios, the better it would be. So one item usually in these ratios, as it mentioned over here, is taken from the income statement, for example sales, and the other item is usually from the balance sheet, which is mostly the assets. As I just mentioned, the turnover ratio of 8 means that each dollar invested in the asset has generated $8 worth of sales over the specific period. Generally, higher this ratio, better would be the situation, but there is a possibility that the window dressing can be done. For example, if the company wants to show that they are generating a lot of sales from their current level of the inventories. Might be at near the end of the fiscal year, they deliberately decrease the level of the inventories, or might be select the fiscal year where when it end, at that time the level of the inventories is already low, and they have might have just recently sold a lot of inventories, but throughout the year there is a lot more inventories sitting in their warehouse. So in that case, the good approach is if you will be able to take the average of these inventories at the end of each month. But if the end of the month numbers are not available, and for example if you are sitting outside and you are analyzing the company from outside and you are not the employee, this number is not easy for you to get. So in that case, it is a better approach to consider their quarterly statements and take the number of the inventories from there, add the last four quarters inventory number and divide by 4, and that will give you a better average for the inventories, and it is better approach to use that in order to calculate the turnover ratio in that case. So the optimal turnover ratio should be close to the industry average. So whatever is the industry average, then for example, if we want to see that each dollar invested in the total assets, how many times the company is generating sales invested in that from that dollar. For example, if it is say 9, then it seems like a big number, but if the industry's average is 17, then the benchmark suggests that the company is not doing better. So you need to look into it again. It's the interpretation, number one. Number two, the trend. You need to see that over the period how these ratios are doing. Are they improving? Are they going bad? And the last one, like how the company is doing against the main competitor, or the best thing is if you'll be able to get the industry average. In At the end, it's not only important, it's not like it should not only be the be your analysis that that a particular ratio is improving. You also need to know the reason, that what is the reason. And again, here the strategy part comes into play, and you need to see that whether these number generation have something to link with the strategy of the company. For example, if the company is going into the expansion, might be they are giving generous sales credit, and in that case like their current level of the receivables, which is again the asset, is takes more time to receive from the customers. So we will look into it over the next few ratios, and I'll give you a exact example using the numbers from one of the real company, and I'm using the company which is Lululemon. So first ratio is inventory turnover, and as the name suggests, that how much like turnover, how many times in a over a particular period, in this case 1 year, the company is able to receive back the sale company is able to sell its current level of inventories. So whenever you sell the inventory, that becomes a part of your cost of goods sold, and we divide the cost of goods sold or cost of sales with the average inventory. And the reason for average inventory means that we need to consider that if there is a seasonal component, we have to get rid of that. For like the sales are not constant throughout the year. Sometimes it's more, sometimes it's less, sometimes there is therefore more inventories, sometimes there is less inventory. So best approach is to, if we have the end of the month figures for the inventory for that particular year, take the average of that. But usually it is not possible. Then the second best approach is to use the quarterly numbers. And if that is also difficult for some people, then the the least priority is given to the method where we are taking the average of the inventories by considering the beginning inventory of the the inventory at the beginning when the year starts, and the inventory the level of the inventory when the year ends. You add them together and divide it by 2, like what I have done for the Lululemon. So in the February 2019, this was the level of inventories. This 404,842. These are numbers in millions, so I am ignoring the three zeros both in the numerator and denominator, but we know that in the ratios it won't affect because these three zeros in the numerator and denominator will cancel with each other. So these all numbers which I will discuss in for the purpose of this lecture are in millions of dollars, and I'm ignoring the three zeros. So I took the average of the beginning inventory and the ending inventory at like the ending inventory at the end of the fiscal year of the Lululemon and divided by 2, and this is how I got the average inventory, and I'm dividing the cost of sales. Like this is the cost of sales which the company has incurred during the fiscal year 2019, but its statement came out in February 2020. And when I did it, I got 3.8. So it means that the current level of inventories, company is selling that current level of inventory 3.8 times in the 2019 fiscal year. And if we'll divide 365 with the inventory turnover, this will tell us that on an average, in how many days the current level of inventories is being sold to the customer. So it is showing that it is approximately 96 days. Again, if the concept is a bit confused, try to understand that. Let's suppose if you have $10,000 in the worth of average inventories, and once they get sold, you replenish them all together. So you keep doing it, and say if it happened 10 times in a year, so it means that the turnover of the inventory in a year is 10 times. And as soon as you'll sell those inventories 10,000, they go into the cost of goods sold. So the average inventories, if the accounting entry, if you remember, it's basically the credit of the you do the debit with the cost of goods sold, and you basically credit the inventories. So 3.8 times in a year. This is the main interpretation. So if you want to remember the interpretation, that 3.8 times in a year, these the current level of inventories is being sold by the Lululemon to its customer, and on an average, the current level of inventories they are getting sold like to the customer in 96 days approximately. So we are simply dividing 365 with 3.8. This number, if it is higher, this is good. We want this number to be high. It means that company is successfully able to sell the current level of inventories many times. So we want this number more, because more they will be able to sell, more profit, gross profit they will be able to generate. And this number we want to be low. So obviously if this number is high, in the denominator we'll get a bigger number, and in the numerator we have the same 365. So the lower this number means if they are taking less days in order to sell their current level of inventories, this is actually desirable. But again, sometime window dressing is done. For example, if the starting and at the end of the fiscal year, the level of inventories is usually very low compared to what it is during the year, then obviously, but to begin with, we have a low denominator and we have this number very big, and obviously this number, because this number is big, and in the denominator this is not 3 point, so this is a typo, this is 3.8 actually. So 3.8. So if this number in the denominator is big, then the inventories turnover in days will be a low number. So one need to be very careful, and therefore it is the best approach is to take the four numbers of the inventories coming out of the last four quarters and take their average in order to best calculate these numbers. So it is up to you if you want to work harder, and but that is a good work, that's more accurate work, you can do it in that way. But if it is not like some analysts do not have much time, then at least we have to take the beginning inventory and ending inventory and take its average. I have gone some extra length, so instead of just considering one competitor, I calculated for the this inventory turnover ratio for three companies in the same industry for the Lululemon industry of the Lululemon, which is the Columbia Sportswear, and its turnover is 2.71 times, lower than the Lululemon. Nike 3.26 times, lower than the Lululemon, and also the Under Armour, which is 2.93 times. And if I'll take its average, the average of these three companies in the industry is 2.96, showing that the Lululemon is doing good job by selling its current level of inventories more times in a year, which is 3.8 times. Now moving ahead, we have another turnover ratio, which is called account receivable turnover. And in order to calculate the account receivable turnover ratio, we need to divide the net credit sales. So the sales which the company is doing on credit, rather cash. Because if we include cash, sometimes you might not have the exact credit sales data from the financial statement. In that case, some people will use the net sales, but that will do not give the exact picture and do not fulfill the exact purpose which we are trying to fulfill by calculating this ratio. And the purpose is we want to see that for the current level of the receivables, whatever the company has, in how many days the company is able to receive those receivables from the customers to whom they have sold their inventory or their product, finished product, on credit term basis. So we will not consider the net sales. We should consider the net credit sales. So first and foremost important thing is try to find the net credit sales rather the overall net sales. Net sales we already have. That's not an issue. For example, the net sales for the Lululemon in the fiscal year 2019, when the statement issued actually, or the year ended actually in the January 2020, it is 3,979,296. Remember, I'm ignoring the 3,000, so it's actually around 4 billion. And I multiplied with the 0.086 because in the Lululemon there are three segments. One segment is direct to consumer. The other, so they sell their products through their online websites. The second one is they sell their product through the store, and the third one is where they are selling to the other businesses and warehouses. And most of the sales which is happening in the stores and which are happening online, they are on cash basis, so they are settled on cash. Like their product price is 100, 200, people pay them through the credit card, through the cash. But when they sell the thing in bulk, and might be they are selling in hundred of thousands of dollars to the warehouses or to the other businesses, in that case those sales are usually on credit basis. And this is what the Lululemon has also mentioned on in their 10Ks, that usually their credit sales are only to the other segment. And in the other segment, they mean to say when they are selling it to the big companies or warehouses. So I'm taking the 8.6% of the total sales, and this will give me the net credit sales. And I'm dividing it with the average account receivables. And this, the reason why I'm taking the average account receivable is the same what I mentioned when I was calculating the average inventories in the previous slides. So we just want to take into account of the seasonality factor. So I'm adding them together, dividing by 2, taking the average account receivable, and then dividing my net credit sales with the average account receivable, and this will tell me that in a given year, or whatever is the period, in this case it's a year, how many times over a particular period the Lululemon is able to receive its current level of receivables, and they are able to collect successfully their current level of receivables, and I calculated it is 9.01 times. Again, we want this number to be higher, and if we'll add these cash over here, like simple net sales, if you are not able to locate net credit sales, you can go ahead with the net sales, and in that case this number will be actually overstated, and it will show that many times in a year the company is able to receive the current level of the receivables. But in that case you cannot compare the company's credit term with this ratio. For example, let me explain you account receivable in days. So simply, if you divide 365 with the account receivable turnover, it is showing you 40.53 days. Now, because I am using the net credit sales, so I'm fulfilling the true purpose of this ratio. So I can see that, let's suppose if the Lululemon's credit or the trade policy is or the credit policy on which they are selling to its customer is 2/10 net 30, it means that the company has 30 days credit policy, and if someone will be able to pay them within 10 days, the company will give 2% discount on those sales. So if 30 day is the credit policy, and if it is going to 40.53, it is showing me that the company collection process is not good, and they need to improve their collection process, and also to begin with their credit approval process has to be good. Why they are selling it to the customer who are delaying the payment, and that's why company is able to recover the current level of account receivable in more days, say 40.53, which is more than 30. So this is the purpose, and we can only compare these days account receivable in days with the company's trade policy if we'll use in the numerator to begin with net credit sales to calculate account receivable turnover. If you are simply using net sales because you are not able to locate the credit sales, then in that case you will not be able to compare the company's credit terms with the account receivable in days. So you need to be vigilant about it when you will be calculating these ratios. Again, first try to find out net credit sale. What are the net credit sale? Look for the 10K. Look, if it's not there, try to Google it, try to search for it. If you are not able to find, it's fine, then you use simply the net sales. But the best approach and the right approach is to use the net credit sale. And what is the interpretation? I just mentioned you how many times in a year company collects its current level of receivable, and this one is telling me, the second one, that it takes almost 41 days for Lululemon to receive collect its receivables from the customers with the current level of receivables. The current level of receivables, they collect it from the customer in 41 days. And again, check the trend, check the industry average. I'm leaving it to you if you want to use the industry ratio by calculating it for more companies, but at least do it for the competitor and compare your numbers with the competitors. And I found that this account receivable days are actually increasing. We want them to be less. We want the current level of receivables to get received and collected as soon as possible, right? So it is taking 41 days on an average to receive its current level of receivables. Compared to the previous year, it has increased by almost 7 days. It was 33 days in the fiscal year 2019, and it was 22 days in the fiscal year 2017. Now, does it make sense? It's like it's main thing I already mentioned, its interpretation. The second thing I also mentioned, it should be compared like that what with the industry. And the third thing, the trend has to be seen. But why it is happening, that's the fourth thing. You want to know why it's happening, and you want to link it with the strategy. I went into the numbers, and it clearly is showing me that in order to keep this ratio constant, this one first to begin with, because this number obviously in the denominator is decreasing. They are able to collect less, like they are able to collect less times the current level of receivables in a year. And why it is less, why this ratio, the last year it was actually 11%, so it's not such a big change from the last year. But prior to that year, means in 2017 fiscal year, remember this is 2019 fiscal year, so in 2017 fiscal year, this number for the account receivable turnover was 16 times, means 16 times they were able to collect their current level of receivables in a year from the customers to whom they are selling their product on credit term basis. And this is simply showing that the percentage by which the account receivable is increasing is much more compared to the percentage by which the net credit sales are increasing. So it in general, the strategy is working. They are actually giving generous credit terms to their customer in order to increase their net credit sales. They are not able to get the same results, but we can, like by this 40.53, it clearly means that they are delaying their receivables. Maybe this is an incentive to the customers to buy their product, and this is how they are doing the expansion and generating more net revenues, which is one of the strategy of the company. They want to have the expansion. This is the expansion strategy of the Lululemon. For Lululemon, in its 10K, which was issued on in February 2020, and this is the financial report for the fiscal year 2019, we can see that this is the sales to others. So there is no direct sales, net credit sales given. So I'm proxying that these others is actually the credit sales, which is usually sold to the warehouses and the other businesses. So usually those are on credit term basis, and this is mentioned by the Lululemon in its 10K. So 8.6% of its total sales was on the credit term basis in 2019 fiscal year, and in 2018 fiscal year it was 9.2%. So likewise, try to find your number if you are doing the analysis, or if the number is directly given, you are very lucky that the credit sales are given. If not, then try to read more, because I found it by the reading that there is some that like the on the credit term basis, sales are done to the warehouses, which is under the others. And so I'm proxying this 8.6% sales as credit sales, which is done to the warehouses. Now, there are many reasons why this receivable turnover might increase. For example, there may be the recession. So I'm talking about the receivable turnover in days, not the turnover. The turnover will actually go into the denominator over here while calculating the account receivable in days. So there if and again we want this days lower, but if it is high, there can be many reasons. Maybe company is not able to recover its current level of receivables because of the inability of the customers to pay in time. Also, there can be bad credit, or the collection process of the company is not good. To begin with, they they sold the things to those people who already have the bad credit. So poor credit approval might be the reason. Then sometimes the company wants to expand its sales, and maybe in doing so they have given the generous credit term basis, so they are less likely to receive the current level of receivables, and they have generous credit term policies. For example, like 2/10 net 60 means that the customer can pay in 60 days instead of 30 days, and if they will pay within 10 days, they will get 2% discount. So if they are not getting the 2% discount, the first 10 days has gone, then mostly the customer will use or avail the next 50 days as well. So this could be the reason. Now, why this receivable turnover in days maybe might decrease? Opposite reasons for that. For example, there is economic expansion, and the customers have better ability to pay off their liabilities, so they are paying the receivables of the company early. Or might be the company has now less generous credit terms, or they might have improved collection process, or better credit approval process, or faster electronic payment processes. So these could be the reasons because of which the account receivable turnover in days can decrease. And this is what we want. We need account receivable turnover, how many times the company is receiving its account receivables, to be high, so that the company should receive more times. But the turnover in account receivable turnover in days, like the pending current level of receivable in terms of days, should be limited. So means they should collect the current level of receivable in shorter period of time. Now, operating cycle, if we simply add the inventory turnover in days and the account receivable in days together, we'll get the operating cycle. So it interpretation is that once the company purchase the inventory, from there onward, the time it takes to sell the inventory, and then receive their cash back from the collect back their account receivables, that actually makes up the operating cycle. So let's suppose if the company has purchased the inventories today, and it takes 30 days for the company to sell those inventories. So those 30 days are like current level of inventories. Then those 30 days are the inventory turnover in days. Plus, let's suppose if those $30 worth of things they have sold in on the credit term basis, and they are not receiving the cash, and they are able to receive the cash back from the customer in 20 days, then in total the operating cycle is 50 days. So 30 days the time during which they are able to sell the current level of inventories, and then the 20 further days at which they will be able to receive the current level of the receivables back from the customers, that make up 50 days. So this shows that how many times does it take, like how many time means how many days does it take for the company, since it has purchased the inventory, to sell the product and receive the cash back from its customers if they have sold those things on the credit term basis. So for the Lululemon, it is 136 days and almost 137 days. So in 137 days, they are successfully able to sell to its customers the current level of inventory, and the current level of receivables they are able to receive back in totality in 137 days approximately. Now we have accounts payable turnover, and the formula is actually the formula should be purchases, how much purchases they have done, divided by the average accounts payable. So whatever is the current level of the payable, this is what company has to pay, because they receive some raw material on credit terms from its supplier, so they have to pay back to the supplier later on. And so the current level of the accounts average account payable, and again, why I'm taking average, for the same reason, we have to account for the seasonality. And once like the payables are this simply suggests that on an average, how much times in a year company is able to pay its current level of payables to its suppliers. Again, it should be purchases, but many analysts, and even when the analysts are doing the calculating the industry ratios, they use the cost of goods sold. So it's fine if you will be using the cost of goods sold, but if you want to exactly find the purchases, then this is the formula: cost of goods sold is equal to the purchases plus beginning inventory minus ending inventory. So if you are beginning with the, say, 10 million worth of inventories, and by the end of the year you have the 20 million inventory, so it means that 10 million, the beginning inventory, is still maybe the part of the last 20 million, and then during the time you also have sold the things, so that sold things are 50 million. So it means that how much purchases you have done 60 million worth of purchases. So if you simply calculate it, you can see that the purchases are 60 million. So this 60 million can be used in the numerator, but because again, I'm mentioning, many analysts simply use cost of goods sold because the industry ratio is calculated in this way. So the interpretation, you need to go with the interpretation that for the Lululemon, the current level of their accounts payable, they are able to pay 20 times in a year. And if you divide 365 with this accounts payable turnover, you will be able to get accounts payable turnover in days, which is 18 days. So on an average, it takes 18 days for the Lululemon to pay back to its suppliers. Now, it's good that this you need to avail this time period, because you are already out of cash, your inventories are stuck, and once you are selling the inventories on receivable basis, because on credit term basis, and so you are out of cash, so you need some cushion. So the accounts payable, the suppliers give you that cushion through the accounts payable. So if, say, you are out of cash for 100 days, and let's suppose if I purchased some inventory today, it took 80 days to sell that, and then 20 further days to receive my cash or receivables from the customer. So I'm out of the cash for 100 days. But if a supplier comes and say, don't worry, for 40 days, do not give me the money. So the supplier is actually giving me the cushion of 40 days. So there is my actual worry is for the rest 60 days, not for the 40 days. So I will try to avail that opportunity, the credit opportunity, to its maximum. So if the supplier is giving me, say, 40 days credit, I will be paying most probably after 40 days, and rather right away. Why should I pay it right away when that opportunity is given to me? But at the same time, stretching of the accounts payable is not suggested, because let's suppose if you'll go beyond that 40 period of time and you try to stretch that cushion, your reputation will not be good in the market. They might stop selling you on credit term basis. They will sell you on the cash basis, or might be that discount or that incentive will be taken away from you, or they might strict this the credit terms for you. Earlier they might be giving you 40 days, now they are just giving you, say, 5 days. So the stretching of account payable is not suggested, unless you are not a very big company who has a negotiating power like Walmart. For the Walmart, the very surprisingly, in I think in in 2011, if I correctly recall, I did the analysis and I found that the accounts payable turnover in days is actually more than the operating cycle. So the company is out of cash, say for 80 days, and the supplier is giving even more than 80 days to the Walmart to pay back. So in fact, they are also using the money of the supplier for their own benefit. So because it's such a big company, they have a negotiating power, but not every company can have that negotiating power. So especially if you are a small company, then stretching of accounts payable is not recommended. So now cash conversion cycle is, once you buy the inventory, if you are buying the inventory on the credit term basis, so you have to pay something, the payables are created, but then it takes some time for those inventories to get sold. Once those are sold, might be you have accounts receivable, so that will be converted into the account receivables if you are selling on your inventory on the credit terms basis. And then from those receivables you need to collect the cash, so you go to the cash, and once you have the cash, you pay back to your supplier, right? Now, if let's suppose from the inventories buying to the cash, if it is taking you 80 days, will the customer or the supplier will wait for the 80 days, so that once you have a cash and then you will pay to the supplier? No, it's not like this. So for 80 days you'll remain out of cash, but there is some cushion given to you by the supplier in terms of the accounts payable. That is actually the, say, 20 days. So that cushion you have to take out from the number of days for which you are not able to collect your cash by selling the inventory. So say 60 days it took you to sell that inventory and create the receivables, and then 20 more days it took you to collect the receivable and collect the cash from your receivables. So there are total of 80 days. But if there is a 30 days cushion, for example, given to you by the supplier, then you need to be worried about only those 50 days. So those 50 days are your cash conversion cycle. So cash conversion cycle formula is inventory turnover in days plus account receivable in days. For the Lululemon, it was 95.97 inventory turnover in days and 40.53 the account receivable in days, minus account payable, the cushion given to you by the supplier, because they are funding a part of your operations by selling the things or the raw material to the Lululemon due to the on the credit term basis. So they are selling you on the credit. So for 18 days you are not supposed to be worried. So that total of almost 136 by subtracting this 18 is down to 118 days and 118 days. So the cash conversion cycle of the Lululemon is 118 days. Do you want it to be bigger or shorter? Obviously shorter. You want to be as short as possible, and for some companies it can be negative if the company is very big. For example, Walmart. I do not exactly know what is happening right now, but the cash conversion cycle for the Walmart is very good, because the suppliers of the Walmart fund their part of their operations for a very long duration of time. So they do not remain out of cash for very long period of time. And even if they do, the major portion of that is funded by the suppliers. Again, check your competitor number, like whether this is big for the competitor. The best thing is the industry, but for the industry you need to have access to the industry's figure. You can do it if you have the access to the Merchant Online, because Merchant Online is the platform. You need to pay for that, and they give you the ratios, the industry's ratios. You can collect the industry ratios from there, or manually you can go and collect the number, but it's very time consuming. So in that case, it's best approach to have a number of the closest competitor and compare your number with the competitor. Again, check the trend. Is it improving or not? Finally, we have last three asset management ratios. One is the net working capital turnover, the other one is the fixed asset turnover, and the last one is the total asset turnover. And the interpretation is the same. If you understand the first one, most you will be able to understand the other two as well. Whenever again the turnover comes to your mind, or you listen about turnover, it means that how many times over a particular period something has done. So over here we are linking the one item again from the income statement with the one item in the from the balance sheet. And the net working capital turnover means that each dollar of investment in the net working capital, how much sales that investment worth of like that dollar in the net working capital is generating. So for the Lululemon, I'm using the same number from the fiscal year 2019 and 18 because it's an average. So first of all, what is net working capital? We know it's current assets minus the current liability. So this green one, I'm taking the number of the and calculating the net working capital for the fiscal year 2019. Again, the statement came out in 2020, but this is the number actually 2000 like it's, you can say it's not 2019 because it's a balance sheet number. So it's actually from the exact date, which is I think 3rd Feb 2020 when the date issued. So this was the net working capital, right, on that day. The net working capital in 2019 in the February 2019 is this much. But this numerator is from the fiscal year 2019. We are using this number from the statement issued in February, but this is actually representing much of the sales happened in 2019. So if I will divide this number with the average of the net working capital, I can see that on an average, each dollar invested in the net working capital, right, after paying off all the current liabilities, whatever is invested in my working capital, it is generating $3.76 in sales. Do we want this number to be big? Yes. For the turnovers, always we need the bigger number. So the interpretation is how much sales a firm generates for each dollar invested in the net working capital over the period. Higher the better. And we can see it has improved for Lululemon. This year it's 3.76 compared to the previous year, which was 3.17, compared to the previous year in fiscal year 2017, which was 2.57. For some industry, for some firms, for example, airline firms, the net working capital is not a big number. And in that case, this ratio can be very high. For some other companies, like the net working capital, for example, retailer, one of the largest asset class is actually the working capital. So in that case, this ratio will be low. So you need to be mindful of that, which industry you are in. And again, it's not only the trend and comparison with the industry matter, it also matters that why you are getting a particular number. And I know in this case, the net, why I'm receiving this, it's basically the numerator actually increased a lot. The net sales, the expansion of the sales, or the growth of the revenues for the Lululemon is much high and it is happening at a higher growth rate compared to the growth rate of the net working capital. So which is good. It means that from the given dollar in the net working capital, they are generating now more sales. The same interpretation is for the fixed asset turnover, where the net sales is divided by the average of the fixed asset for the Lululemon. Means every dollar invested in the fixed asset in the Lululemon, the company is generating $6.42 worth of sales. and this is again good. And we want this number to be higher. It means that the company is efficiently utilizing its fixed assets. And what are the fixed assets I have collected over here, in the like used over here in the computation in the denominator? I have used the property, plant, and equipment, and that is actually the fixed asset. For the capital intensive industries, this, for example, railway, airline, this number is actually very big. And normally you might have heard that sales lag the expenditure. So normally, in because of that, this it takes, once you induct some new plant, property, and equipment, this denominator will inflate, but the sales will come uh, like later on. So in that case, this ratio can be small sometimes. So you have to be mindful. You need to see which industry you are working in, or let's the company which you are analyzing, which industry it like this company is in. Is it a capital intensive industry, or it's not a capital intensive industry? Finally, with the same interpretation, we'll move on to the last ratio, which is the of the asset management ratio, which is the total asset turnover ratio. And here we will develop the relationship between the net sales and the average of the total assets. And we can see that each dollar invested in the Lululemon's total asset is generating $1.48 in sales. Same interpretation, we want this number big. We also need to see the trend, and we will also look at that what it is, what we will compare it with the benchmark number from the industry. And if the industry number is not there, you by this time you know that we need to see that what is the number of the for the same year, for not for the same year, what is the average of the competitor over the last 3 years. So in summary, we have learned 11 asset management ratios and how to interpret it. If you are okay with that up to this lecture, you can stop. Otherwise, I will be showing you my Excel file, that how I did the calculation in my Excel file. So you can see I have calculated these ratios, these 11 ratios, the asset management ratios, and I have written the formula over here, so that uh, anyone can readily see that what formula is used. And I use this number over here. You can see that this income statement number E4 definitely will have the cost of goods sold. Let's go and check what is the number. Yes, this is the E4, which is cost of goods sold for the fiscal year 2020. And we are dividing it with the average of the balance sheet of E7, and that E7 and F7 definitely will be giving me the average inventory for the from the latest year and the previous year. So E7, you can see, is the inventories. E7 and F7, I took the average in order to take into account the seasonality. Ideally, I need to use the 4 year quarterly numbers, but it's fine if you are using the beginning and ending year inventory for the calculation of the average inventory. And I did it for the all 3 years. Now, in order to calculate the oldest year, you need to have the previous number from the 2017. And actually I have 2017 number. If I'll unhide, I can show you that I have downloaded the previous numbers as well. But if you do not have the previous numbers, right, you can simply leave this one as it is. So keep it blank, right? But it's better if you can do it. But if you can't do it, it's fine. Keep it blank. But wherever there will be the averages, remember, because these, for example, average account receivable and the average accounts payable, we will not be like, if you do not have the 4 years of number, you will not be able to calculate this the number for the oldest uh, year which you have if you are just downloading the 3 years of statement. So you need to have the fourth year of statement as well to calculate the wherever there are averages used in the denominator for that ratio. But because I have, so I'm going with my calculation. And again, you need to do the calculation with your competitor and take the average of this ratio for the competitor and write in front of this. For example, for the Lululemon, the average for the asset inventory turnover is 3.93. You can see that over here, right? So you add them together, divide by 3, so it is 3.93. So in when you will become computing, like calculating these ratios for your competitor, take this average of your company and write in front of that. Likewise, these three averages of the competitor, take its average for the last 3 or 2 years. If you are able to calculate, if you are doing the calculation only for the 2 years, then write in front of this, like there, for the like this. These numbers are not updated for the Under Armour because I do not have I have not downloaded the latest number for the Under Armour. So these are actually mostly from the averages of the fiscal year 2018, 17, and 16 for the Lululemon. So for the Under Armour. So this is not updated, but I think you have understood what I meant to say. Download the latest year and update. Take the average of these ratios of one company and write it in front of the ratios of the other company, just to do the comparison, so that I can see that what on an average your competitor is doing in the last 3 years, and how well your company is performing against that average. So this is the purpose, just to show you that all these numbers are coming with from the source statements, which is the income statement and the balance sheet of the Lululemon. Likewise, you need to do it with all these formulas. So use the formulas rather hand type the numbers for the analysis. Thank you.